Have you ever wondered how fixed income ETFs can benefit your portfolio? Let's dive into this fascinating financial world together. Fixed income ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product, with shares that are tradable on a stock exchange. They offer investors an avenue to access a broad array of fixed income assets, such as bonds, in a single transaction. When it comes to crafting a well-diversified investment portfolio, fixed income ETFs can be a game changer. They can provide your portfolio with a steady stream of income, while also serving as a buffer against the volatility of the stock market. These ETFs can reduce risk, offering a sense of stability in turbulent times. They're like the reliable friend who always has your back in the financial realm. Now that we've established the role of fixed income ETFs in a portfolio, let's delve deeper into the different types available. First up, we have government bond ETFs. As the name suggests, these are ETFs made up of government-issued bonds. Governments issue bonds to raise money for various public projects or to manage their debt. When you buy a government bond, you're essentially loaning money to the government. In return, you're promised a fixed rate of interest over a specified period, and at the end of that period, the bond's face value is returned to you. The beauty of government bond ETFs lies in their security. They are backed by the full faith and credit of the government, making them a low-risk investment. Some popular examples include the iShares U.S. Treasury Bond ETF and the Vanguard Total Bond Market ETF. However, while they are low risk, they also typically offer lower returns than other types of bonds. So, that's government bonds for you, a safe and secure option. But what if you're looking for something a bit different? Stepping into the corporate world, we have corporate bond ETFs. These are funds that focus on bonds issued by corporations. The concept is simple. Companies borrow money from investors, promising to pay back the principal amount with interest at a future date. Corporate bond ETFs pool these individual bonds together, providing investors with the opportunity to own a slice of many different bonds with just one purchase. This diversity can help to spread risk and generate a steady income stream. There are various types of corporate bond ETFs, such as those that focus on high-yield bonds, which are bonds from companies with lower credit ratings but higher potential returns. Or investment-grade corporate bond ETFs, which include bonds from financially stable companies. Examples of popular corporate bond ETFs include the iShares iBoxx Dollar Investment Grade Corporate Bond ETF and the SPDR Bloomberg Barclays High Yield Bond ETF. Investing in corporate bond ETFs can carry risks, such as credit risk and interest rate risk. However, the potential for higher returns can be an attractive proposition for many investors. Corporate bonds, a way to invest in the success of businesses, but there's one more type to explore. Lastly, for those interested in supporting local government projects, we have municipal bond ETFs. These ETFs are composed of bonds issued by cities, counties, or states, usually to finance public projects like schools, highways, and infrastructure. They provide a unique opportunity for investors to support local communities while also generating income. One of the main benefits of municipal bond ETFs is that the interest income they generate is often tax-exempt at the federal level, and sometimes at the state and local levels too. However, it's worth noting that they do carry some risks, such as credit risk, if the issuer defaults on payments. Some popular examples of municipal bond ETFs include the iShares National Muni Bond ETF and the Vanguard Tax-Exempt Bond ETF. These funds seek to offer broad exposure to a diverse range of municipal bonds, providing investors with a balanced and tax-efficient income stream. With municipal bonds, your investment can help facilitate community growth. Now, how do you integrate these into your strategy? So, you've got these fixed income ETF options, but how do you make them work for you? Integrating fixed income ETFs into your investment strategy is a balance of understanding your risk tolerance, investment goals, and current market conditions. Risk tolerance is about how much market volatility you're prepared to withstand. If you're a cautious investor, government bonds ETFs might be a good fit. They're generally lower risk but offer lower returns. On the other hand, if your investment goals are geared towards growth and you can handle a bit more risk, corporate bonds ETFs might be more suitable. They typically offer higher returns, but with a higher risk. And let's not forget about market conditions. In a low interest rate environment, for instance, you might lean more towards corporate bonds ETFs for their higher yield potential. With the right strategy, fixed income ETFs can be a valuable addition to your portfolio. Remember to like, comment, and subscribe for more investment insights.